Good evening and welcome to World Investor Week 2020. On behalf of the Center for Capital Markets and Risk Management, IIM Bangalore, I, Anvesha Sinha, welcome you all. Our speaker for this webinar is Professor Shobhit Agarwal. Professor Shobhit has worked in various financial firms like ICICI Bank, Irevna Research Services Limited, and Adventity Global Services Limited before completing his FPM from IIM Bangalore in the year 2015. Currently, he is working as an assistant professor in IIM Udaipur. His research interests lie in tax effect of dividends and stock market behavior. Today, he speaks on what caused the global market meltdown during the COVID pandemic, lockdown, stringency, or investor panic. We welcome you, sir. The webinar will be followed by a Q&A session. The chat window will be kept switched off during the whole webinar. Thank you.
Thank you, Anvesha. Today, good evening all. Today I'm presenting my most recent research paper titled What Caused the Stock Market Meltdown During the COVID Pandemic. My co-authors were Professor Samarpan Non and Professor Amish Dugard, both my colleagues here at IIM Udaipur. Now, I'll give you a brief background on where this paper, started coming about from. This is, so if you are investing in the stock markets, this is what you saw as the stock market performance, at the end of March 2020 for the last 3 months. Tell me a simple question, or think of a very simple question. If you saw this chart, what would you say? Is it a good time to invest? Now, in hindsight, of course, it was a great time to invest, because since then we know, now that 7 months have passed, we know that markets have risen 70% since, the bottom, which is shown here. But imagine that you were standing here, not having the benefit of this hindsight. The markets in the last 2.5 months have fallen from 12,500, this is Nifty, has fallen from 12,500 to 7,500. Would you be scared to invest? Or would you think, this is a great time to invest? Or would you think of something else, right? That's the question that, we started with. So sitting there in March, we were thinking, has the market bottomed out? Is this a great time to invest, right? Now, notice that in March this year, the 12 most liquid countries or 12 most liquid stock markets in the world, all of them fell. The highest fall was recorded in India, which was 23.25 percentage points. The lowest fall was recorded in China, which was 4.5 percentage points. But every market of the most liquid markets, each one of them fell in March, right? Now, so is this a good time? In hindsight, of course, it was a great time, but how do I take a decision, right? So I was discussing this with one of my co-authors, for our personal investment, and I was of the belief that markets have overreacted, people are way too scared. And as Warren Buffett said, invest when people are fearful, right? That is really a great time to invest. So I thought this is a great time to invest because, there's no stable reason for the markets to remain low. And my co-author said, it's not that way. He said, you see, the Prime Minister has just announced the lockdown, right? Nationwide lockdown, you don't know how long it will last. You don't know how long the COVID pandemic will last. A nationwide lockdown means that economic activity goes down significantly. And if economic activity goes down, growth goes down, companies which are profitable will start making losses. And hence there's a solid reason for the markets to fall, right? And both the reasons seem reasonable, right? So how do I again decide? Is this a good time to invest? Or is this not really a good time to invest, right? Now, we got to understand. So basically, there are two reasons or two components of the stock market return that we were witnessing, the fall that we were witnessing, right? One is that, well, the growth expectations of investors have changed. They are far lower because economic activity was expected to go down. And the other, of course, is that, well, as I said, people are scared. The investor sentiment is kind of low, right? Okay. Now, the reason why this is critical, why dividing into these two reasons is critical, is because if it turns out that the true reason for the fall is a growth reason, then I can't say when the market will rise up again. Because, well, the growth story, you don't know how long the pandemic will last. Sitting in March, you don't know how long the lockdown will last, right? And hence we have no idea. But if it's the fear story, then both conventional wisdom and academic research shows that fear is not, stock market fear is not a long lasting phenomenon, especially if it is, based on, if it's not really based on something very, very solid, right? Something which is expected to continue forever, right? So basically what we are saying is that if we can find out what was the true cause of the market fall, whether it is investor panic or whether it is a expected lower growth, then we can take a call on how long are these low levels of low stock market levels expected to persist. And if they are not expected to persist, then it's a great time to invest. And if the market is expected to remain low, then we probably could wait a bit, right? Now that's a question that a lot of us seem to be asking at a lot of times, right? Is this a good time to invest? So even though the key results of the paper don't answer that particular question, I think what we've done helps answering that question. So I'll come to that part of it, right? So effectively, what I'm saying is that the two possible reasons, one is a short term, which is investor panic, right? And the other could be medium term or long term, right? We don't know growth, how long the growth is expected to remain low, right? I mean, now we know that growth has started, turning around. With hindsight, we can say it would have lasted 6 to 7 months. We couldn't say this in March, right? Okay. So again, the same question: how do we decide sitting in March whether it was a good time to invest? The answer, as I said, lies in being able to decompose the total returns into these two components. The returns because the expected growth of investors changed, and the returns because investors are just way too scared, right? Now, how does the returns because investors are scared pans out in the stock market, right? It pans out effectively through the investors asking for more return, right? When they are scared, investors say, till yesterday you were giving me, let's say, 4% over and above the risk-free rate. I'm not happy with 4% over and above the risk-free rate. I want now 5.5% or 6% over and above the risk-free rate because the stock markets are way too risky, right? That is how investor fear really shows up in the stock markets. Okay, so effectively what we are saying when we are saying that there's investor panic is that investors have suddenly started demanding higher market risk premiums. Okay, now can this be done? Can we break the total returns down into its component returns? Interestingly, we show that after making some reasonable assumptions, it can actually be done and done very well, right? The other interesting fact is the tools that we use to decompose the total returns into its two components have been there for the last 50 years. But to the best of our knowledge, we are the first ones who've decomposed the total returns into the two components, right? Okay. So how do we go about isolating the returns due to growth and investor sentiment, right? We start, so, okay, for the next 10 odd minutes, I'm going to get into some technical stuff, but even if you don't understand the math or the technical stuff, let me give you the basic intuition, right? So as I said, that the market value is determined by two factors, right? What is it that investors expect about future growth, and how much return over and above the risk-free rate do the investors want from investing in the stock markets, right? Now, what we do is we take analyst estimates. So let's say analysts give us some sort of idea about what is the future expectation on cash flow. So one of these two pieces, which is future growth expectations and expected return, is sorted, right? We know how much it is because analysts tell us how much it is, right? Uh, the other can be back calculated given the state of the market, right? Given where the index currently is. This concept is called implied market risk premium or implied equity risk premium, right? This is something also which has been established for at least the last 20, 25 years, right? Now, where our contribution comes in and what we do here is we take this implied market risk premium and then we say, let's go 1 month forward. Let's say we estimate all of this in February 2020, right? Then we go to March 2020, and then we say, let us take the updated cash flow forecasts by the analysts, right? Stock market analysts for March 2020. But let us not update the market risk premium. Let's continue using the market risk premium, which was applicable in February 2020, right? And then let's calculate, given all of this, what would have been the value of the index if this were true. This is a hypothetical value of index, right? It doesn't exist. So we calculate this hypothetical value of the index, which has updated cash flow forecasts or updated cash flow expectations, but which does not have updated risk expectations. The difference between this hypothetical March index value and the actual February index value is the return which we attribute because, well, the growth expectations have changed. Because by construction, only the growth expectations were allowed to change. Risk premium was not allowed to change. But we also know what the actual return from February to March is, right? So once we have the returns which are due to the growth changing, the residual returns are because the market risk premium is changing or because the investors are saying, now we want more return or now we want less return for investing in the same equity markets, right? It is as simple as that. Now, this was the broad intuition. Let me get into the math, right? So we start with the most basic valuation model, which is that the value of a stock is nothing but present value of its future cash flows. Now here CF1, CF2, these are cash flows in future years. So CF1 is the expected cash flow from a stock next year. CF2 is the expected cash flow 2 years down the line, and so on and so forth. And KE is nothing but cost of equity or the return that you expect from investing in a particular stock, right? Okay. Now, if we use a well-established model called capital asset pricing model to estimate cost of equity, we get the formula that cost of equity should be, well, at least the risk-free rate plus something extra for, well, how risky this particular stock is relative to the market and how risky the overall markets are, or how much extra return I expect from investing in stock markets at all, right? So RM minus RF is that portion which is the extra return that I expect because I'm investing in the stock market, so market risk premium. And beta is how sensitive is this one particular stock relative to the entire market, right? So this is broadly the idea of how much return we expect from investing in one particular stock, right? Okay. Now look at the same equation, which is equation 1, which says, present value of all future cash flows. Now, if we say that, okay, after 3 years, the entire market, and I'm not talking at the stock level, I'm talking at the market level. The market is going to be in a stable growth phase, right? I can then rewrite this equation in the following format, right? I've just said all future years are subsumed into this one terminal value number, right? So what we are saying is that this effectively resolves the entire. Now we don't have an infinite equation, right? It's a closed form solution. Okay, it's a same story. The only new factor that I have introduced now is something called G, which is what is the expected stable growth from year 4. I mean, after year 3, right? From year 4 onwards, right? Okay. After this, so till this point of time, there's no assumption. This is all established theory in finance. Okay, something which is very well known to most financially literate investors, and most anybody who's done an MBA would know this. Anybody who's done any sort of a finance course would know this. Okay, beyond this, we make the reasonable assumption, right? We need a proxy for this stable growth. So we say that the risk-free rate in a country, which is again proxied by the 10-year government bond rate in the country, is a good proxy for long-term stable growth in the country. Now, let me back this assumption up with some concepts, right? So why would this be true? Well, the risk-free rate is the rate at which consumption of goods and services grows in any country. Now, why? Because, well, you can put $100 in at the risk-free rate and get 100 plus the risk-free rate back, and you have that much extra to consume next year, right? So this is the rate at which consumption of goods and services grows. The expected growth rate is the rate at which production of goods and services in a country grows. Okay. Now, in equilibrium, in the long run stable state, both of these have to be equal. Because if the consumption rate is higher than the growth production rate, then you will at some point reach a stage where people don't have enough to consume. And if the production rate is higher than the consumption rate, then you will reach a stage where there's too many surplus goods and services. And then at some point of time, people are going to say, you know what, there are a lot of free goods and services available. Why don't we start consuming more, right? So the broad idea is that in equilibrium, consumption rate has to be equal to production rate. And hence we can say that in equilibrium, risk-free rate is a very good proxy for the stable growth rate for any particular country, right? So that is what we use. And then we say, we are not going to value any particular one stock. We are going to value entire stock markets, right? So we start with the 12 most liquid stock markets, and to value the entire markets, by the way, notice that the moment we say RF is equal to stable growth rate, this factor KE minus G goes to just beta into RM minus RF. This is, you can see here, right? The moment I put RF is equal to G, KE minus G will become RF minus RF, which cancels out. So it becomes beta into RM minus RF, right? So, and this can be further solved because the moment I'm saying I'm valuing the entire market and not an individual stock, beta by definition is 1, because beta is sensitivity of the security with respect to the market, and sensitivity of the market with respect to itself is by definition 1, right? And hence the equation just reduces to this, right? Notice instead of K minus G, now I have the market risk premium, or RM minus RF, right? Now look at this equation. The value is nothing but, if I assume that the market is correct, right, then the current Nifty value or the current stock price value, right, the current market value is equal to value. I need future forecasts of these cash flows, right? This stock analysts give me from Bloomberg, so I take it from Bloomberg. The only factor which is not known here, risk-free rate is known. I can go to the RBI website and find out what the risk-free rate is, right? The only factor which is not known is cost of equity. In this case, cost of equity, because I'm talking about the entire market, cost of equity is equal to RM. So there's only one unknown in the entire equation, right? So I can back calculate this unknown and call it implied market risk premium, implied market returns, right? Okay. So that is what we do, right? We take consensus analyst cash flow expectations for the index from Bloomberg. This is something that Bloomberg provides, right? So you don't just get analyst expectations for individual stocks. You also get analyst expectations for, for the entire indices. So they take some sort of a weighted average of constituent stocks of the index, and that gives you analyst expectations of what, how they expect the entire index to do. They create the index as a representative stock, right? So we take the cash flow estimates from there. We have the risk-free rate. We have the stock market value. We calculate the implied risk premium for each stock, every market, every stock market, which is the 12 most liquid countries, for every month starting from January through May, right? Okay. Now, the question is, we still have to break the total returns down into growth and market risk premium. So as I said earlier, now we estimate a hypothetical index value with updated analyst expectations of these cash flows, but with previous month's implied equity risk premium, not the current month's implied equity risk premium. So what this does is now we have an expectation of market return if market's expectations had not changed, because the implied equity risk premium is the previous month's premium, right? But the cash flows are updated and we get a hypothetical index value. The difference between this hypothetical index value and the actual index value in the previous month is the return that is attributable because growth has changed, right? Or expected growth has changed. The residual returns are equal to are attributed because, well, the market has changed how much premium it wants for investing in the stock markets, right? Now, when we do this exercise, so notice if you just look at this first column, these are the countries, by the way, that we took: Australia, this is in alphabetical order: Australia, Canada, China, Germany, Hong Kong, India, Japan, and so on and so forth. Notice that the total stock market return in March, this is just for exposition purposes, for each of the markets was negative. By just looking at this column, I can't say whether it is a good time to invest or a bad time to invest. But then I break these returns down using the methodology I just showed into returns which are attributed to growth, because growth expectations have changed, and returns which are attributed because the market risk premium requirement has changed. And as we argued earlier, this is something which we expect to stay for as long as our growth expectations are expected to be low. But this is because of sentiment, which we don't expect to last. So if we see a sharp fall here, then we say it's a good time to invest, right? So, I mean, this is not something that is part of the paper, but something that I am, arguing here. So look at this. Even though the market fell for all these countries, South Korea was not really a great market to invest, right? UK was not really a great market to invest. But look at India. Just because the people were scared, just because there was panic in the stock markets, the Indian stock markets fell by 23.24 percentage points. This is something we don't expect to sustain. And hence, using this, we can say in March, if this number is very significantly negative, yes, this is something which is because investor sentiment has changed. As long as you expect that sentiment is not going to last for a long period of time, this is a good point to invest. Yeah. So this is not just for pandemic. You can try using this methodology at any point of time. And the moment you see a huge negative number here, you can say that, yeah, this is probably irrational and maybe we can go ahead and invest more. Okay. But the litmus test of our results comes when we got to prove that the decomposition that we've done here works, right? So here's the thing. If this works, if the decomposition is correct, then the returns due to growth should be negatively impacted by higher lockdown stringency. Greater the lockdown stringency, greater the impact on growth, and hence, greater the stock market fall because of growth expectations. Similarly, greater the panic in the country, lower the investor sentiment, and hence higher the stock market fall because of panic, right? Now we got to prove that this actually happens. So we need two proxies, one to measure how stringent the lockdown is, and another to measure how much panic there is in the stock markets or the country in general. Okay. Now, let's start with panic. To measure panic, we use the coronavirus dashboard, which is provided by Ravenpack. They create a panic index for every country. They provide that data daily. You can go to their website. It's available to see for everyone. It's not chargeable. Okay. Now, for each of the countries, we pick this panic index number from January through May. Okay. What this actually measures is, so Ravenpack is basically an agency which, tracks the media of various countries, the news agencies, right? So what they are effectively measuring is what proportion of the total news that is available in a country, or news chatter that is available in the country, relates to panic and coronavirus. As simple as that, right? Okay, here are the values. Okay, this is just for exploration purposes again, right? So in the US, the highest panic value, remember US never had any lockdown, right? The highest panic value was recorded in March, which was about 6.13. Remember what happened in March in the US? There were news about supermarkets running out of toilet paper. People were stocking toilet paper because they didn't know what would happen, right? Notice also that in Hong Kong, by March, they had started to control the coronavirus. The peak of coronavirus in Hong Kong was earlier in January and February, right? And as expected, the panic is also more in January and February, right? Okay. Now, the next measure is, well, how stringent lockdown was in various countries, right? So for this, we use a stringency index provided by ourworldindata.org. This is an open source data provider. They, in collaboration with Oxford University, they provide various points of data around coronavirus. Okay, this pandemic. One of which was how stringent the lockdown is. This is just an additive score based on 9 indicators. These indicators, they kind of include like whether schools were closed, whether public gatherings were banned, whether public transport was closed, and so on and so forth. All of this, of course, was scaled to 100, right? Notice on 24th March 2020, the Prime Minister of India had announced a complete lockdown, a full ban on practically every activity, which is why you see on 31st of March in India, this value is 100. The lockdown continued to a significant level in April. So even by the end of April, it was 96.3. And then the unlock had started towards May. So at the end of May, it was slightly lower. On the US, the numbers were slightly different. There was never a full lockdown in the US, and hence the value never reached 100 in the US, right? Okay. Using these, what we next did was regressed the returns due to growth and returns due to panic on stringency index and on panic index. Now, what do we expect? We expect that returns due to growth will have a negative coefficient on lockdown stringency, right? So notice that returns due to growth have a negative coefficient on lockdown stringency and is statistically significant at the 1% level, right? Similarly, we expect that returns because of panic or market risk premium updation would have a negative coefficient on panic. Higher the panic, lower the returns, right? However, we also find an unexpected result, which is returns due to market risk premium updation were positively impacted by the stringency index. Okay, what this means is that more stringent the lockdown, safer the stock market investors were feeling. Now, we haven't completely explained this particular phenomena, and because it was beyond the scope of our paper, perhaps it can be researched in detail at a slightly later point of time. But our expectation is what's happening is, as lockdown is increasing, investors are feeling that soon we will overcome this COVID pandemic and markets will get back to normal, and hence with increase in lockdown stringency, even the market risk premiums kind of reduced and stock market started, would go up. So this is what we find. Okay. Now, the issue is these opposite signs because of MRP updation on stringency and panic create, some sort of question. Are the two related, right? Okay. So by the way, this is just, how economically significant these results were. So as panic rises, as I said, the returns due to MRP fall. And we notice that one standard deviation change in panic causes the stock market index to fall by 4.35 percentage points. Similarly, as lockdown stringency rises, returns attributable to growth fall. One standard deviation change causes the markets to fall by 6.5 percentage points, right? The surprising result, as I said, was that as stringency increases, returns due to MRP also went up, right? Now, as I said, the first question, because of these opposite signs on stringency, is stringency and panic related? Maybe they are strongly correlated, and hence, if they are strongly correlated, then the results that we are showing would probably be spurious. Okay, so we did two tests. The first thing, a very basic non-parametric test. We checked whether the correlation coefficient between the two indices was high. We found it was very, very low. Okay. The second thing that we did was we regressed the panic index and stringency index. And then in our results, instead of using the actual panic index, we use the residuals of the panic index. Okay. Now, even if panic and stringency are related to each other, the residuals of panic would not really depend on stringency any longer, right? So now the residuals of panic and stringency are completely independent of each other. We rerun the regressions, we find identical results, right? There's no difference in the results. Okay. The second source of error which was possible is, we only did the analysis of 5 months, 12 countries, which is 60 data points, right? So when we originally submitted this particular paper, we only had 5 months of data. So then we said, when the revision came, let's extend the data period and check. Okay, so we extended the data period to 8 months through August, ran the entire analysis on 96 data points. We again find that the results hold. Okay. Now, the last source of error that we tested was, maybe the results that we are finding are not because of panic and stringency, but because of some other differences across countries, right? Maybe it is the stock index volatility is different. Maybe the government bond returns are different. Maybe the exchange rate fluctuation is different, and so on and so forth, right? So what we did was we included these variables in our regressions, as control variables, and we conducted the tests again. And we again find the identical same thing, that the results still hold. Okay. So what do we conclude? Well, we conclude that, well, as I said, we were able to decompose the stock market returns into the two parts: returns due to updated growth expectations and returns due to the updated market risk premium expectations. This is what we believe is, our key contribution. But we also find that returns due to growth are negatively impacted by lockdown stringency, and returns due to the market risk premium updation are negatively impacted by the level of fear due to COVID. Well, that's all that I had to say. Thank you. I'm open to questions if there are any. Yeah.
We will take up questions now. Please write the questions in the Q&A section.
And returns due to the market risk premium updation are negatively impacted by the level of fear due to COVID. Well, that's all that I had to say. Thank you. Yeah. Sorry. Are there any questions?
Please write in the questions in the Q&A section for Professor Shobhit. Sir, I believe the presentation was so self-explanatory, but yes, we do have a question from Mr. Arnab Biswas. How do you update MRP due to changes in growth expectations?
Okay, so Arnab, MRP does not change because growth expectations change. MRP is, that how much extra return I expect for investing in the markets, right? That changes when my risk appetite changes. That changes when effectively I'm saying that yesterday I was, for the same amount of average market risk, I was happy with 4% returns. Now I want 4.5 or 5% extra returns over and above the stock market. So when growth changes, my expectations of cash flow change, but when growth changes, my MRP does not change. Right? Okay. So there's a second question. It says, okay, shouldn't the question be whether to sell or not? Okay. Interesting. So depends on how scared you are of the market, right? So, or if you're asking about right now, today, whether we should be selling or not, yeah, the answer can be found out by doing the same analysis today, finding out what the return due to MRP changes. And if you see that, the return due to MRP change is significantly positive, then yeah, it might be a correct time to sell. But sitting in March when the markets had already fallen by 40%, at least conventional wisdom says that, well, this is the question you should be asking is it a good time to buy, right? But yeah, if your risk appetite is too low, then you should be thinking about whether you should be selling. Yeah. Okay. So there's a third question by my friend Anish. Why do you think that the Chinese stock market was not affected as much as the Indian stock market, even though the pandemic began there? Okay, so great question, Anish. Uh, okay, I think the the idea here is that market participants tend to behave differently in different countries, right? And somehow, with the way the Chinese were controlling the coronavirus, especially by the end of February, March, there was not enough reason for investors in the Chinese market to feel scared or to demand higher market risk premium, because there was far greater confidence that China would be able to control the coronavirus, as was visible by the end of March. Okay. The next question, given the situation, what is the Nifty index expectation for near future? Uh, I'm really going to skip this question. I mean, if I knew the answer to this particular question, I would already be a millionaire. So all I can really say is, that I'll actually go ahead and do the analysis, find out what is the change due to MRP updation, and if I find that the change due to MRP updation is very significantly positive, then I'm not going to be too bullish on the market given the current state. But if it's flat, if it's close to zero, then you expect standard, whatever is the expectation of growth in the market economy in general. That is what you expect the stock markets to return. Okay. So another follow-up question by Anish. How did the mutual fund industry, especially in India, behave during the pandemic? Uh, Good question. So this is not something I studied at that point of time. Yeah, I'll probably have to look into this. Okay. Uh, okay. The next question by Arnab, which says, what was the nature of fiscal interference bond to equity yield controlled? Okay. So see, the fiscal interference, how will the fiscal interference affect our analysis? Through expected growth. So what we are basically saying is whether there is fiscal expenditure, whether there is no fiscal expenditure, the channel through which it affects the stock markets is by changing expected future growth. Now we are not really forecasting expected future growth for the next 2 or 3 years ourselves, right? We are trusting that the consensus estimates of stock market analysts, which we are taking from Bloomberg, is going to do this analysis. So whether it expects higher growth or lower growth is all taken care of by the analysts. We are basically trusting them, right, to know this answer. Okay. And the last one is, it's a suggestion, I think, by Anish. He says that I could expand the paper by decomposing the behavior of individual and institutional one. That's a great suggestion, Anish. Thank you, and we'll definitely look into that. Right. So,
Thank you, sir, for the wonderful presentation.
Andresha, I think there's one more question. Okay.
Okay. Yes, sir.
Yeah. As it is impossible to guess if the market has hit the bottom, will it not be better for the market to pick up before investing? Entering in April, May would still have given very good return. This is a question from Rajiv Agarwal. Rajiv, you're right. So the answer to that question really depends, on what kind of investor you are. Okay. I've heard various different investing, methodologies or investing regimens from people. Investing behavior. One very commonly exhibited investing behavior was when the market started falling towards, the starting of, let's say, the end of first week of March, a lot of investors told me, I will keep investing small amounts till all the way down, okay, till the point that the markets keep going down. So maybe 10% of the total amount that I want to invest every 2 or 3 days, okay, and I keep doing it. The other is, as you said, okay, so what you're saying sounds to be a good strategy. I followed this particular strategy for my own portfolio, but all I'm saying is there are other ways also to decide when is a good entry point, right? Or when is the best entry point. I don't think you're asking the question whether it is a good point or a bad point to enter the stock markets. You're asking the question, is it the best point, or is there something better which is available, right? That question is still something we haven't answered through this paper. And at least we don't know how to answer that question. We can answer whether it's a good point or a bad point to enter the stock markets. We can't answer whether it is the best point to enter, whether something better is coming up, right? So yeah, no more questions. So yeah, thank you.
Thank you, sir. An extremely well explained presentation. And thank you to all our viewers for attending. Thank you.
Thank you, Anvisha.